In this lesson, we're going over the perpetual inventory system. And if you guessed it correctly, you would realize that the perpetual inventory system is the system that updates inventory after each transaction. And so this system is definitely different from the periodic system. And here we'll be able to see exactly how it is different because I'm going to use the same example for both transactions for the transactions posted, and we're going to look at the difference between the two, what makes them different. And so we're starting with the perpetual inventory system. And so here are the transactions that we are going to record. On the left are all of the transactions for a particular company for the month of April, and on the right we'll just record everything in journal entry form for each transaction. So let's get started. First, April 2nd, inventory was purchased from Walmart to be sold by T&T School Supplies. 100 textbooks were purchased that cost $25 each. So that's the first transaction we have. What are we understanding about the transaction? Well, we understand that we're spending money to purchase inventory, which are the textbooks. So when we think of something like this, what type of accounts would be affected? Well, we're purchasing something. It doesn't say we purchase it on credit, so definitely there's a cash account that's going to be affected. So let's start by writing that down. Cash is going to be affected, and then another account that's going to be affected is inventory, and we call that merchandise inventory. That's because this business is in the business of selling school supplies, and they're purchasing textbooks. Textbooks are school supplies. So that's going to be a part of their inventory that they're later going to sell to customers. And so that's why it falls underneath merchandise inventory. So these are the two accounts because there's nothing else going on in this transaction. So therefore, these are the only two accounts affected. Let's go down to how are they affected. Well, the cash account, we're spending cash because it costs us a certain amount. So we're spending cash, which means that the cash account should be decreased. Cash is an asset account, and therefore to decrease an asset account, we actually have to credit it. So this should actually be at the bottom here, because we should remember our debit should be at the top, credits at the bottom. We know cash is a credit, so that should be below and it should be indented. Merchandise inventory is also an asset account, and because we are buying 100 textbooks, we now have more textbooks and we have more inventory. So therefore we increase that account, and an asset account is increased by a debit. So that's the start of our journal entry. We have to put the date for 2/20, April 2nd, 2020. We'll use that. So now the only part that's missing from our journal entry is how much are we increasing it by, and or how much are we increasing and decreasing these various accounts by. We say that we buy 100 textbooks and they cost us $25 each. So it's very important to note then that we should be increasing the value of our inventory by $2,500. And that meant that we spent $2,500 at Walmart to purchase these items. And so this is our first entry completed because it's only two accounts, debits and credit, and they balance. We spent $2,500 to receive books that cost us $2,500. And so a brief description here: purchased inventory with cash. And that would be the first transaction there. So the second transaction for 7/20 is the date then when it actually happened. So that's what we record. It says the Anglican school came into the store and purchased 30 books. 30 books for $50 each on credit. So let me just make this correction here. $30. Not $30 books. Okay. So they purchased, the Anglican school came into the store and purchased 30 books for $50 each on credit. So that means what's happening in the transaction? Well, we're actually recording that we're selling some goods. So if we're selling goods, how do we record selling goods? How do we record selling these textbooks? Well, normally when you sell something, you're adding to your revenue or you're adding to your sales. So one of the accounts we definitely are going to affect is maybe textbook revenue. Can be an account. Revenue and sales are interchangeable. And then it says we sold it. Did we sell it for cash or did we sell it on credit? We sold it on credit. And so that means that the account that's going to be affected is accounts receivable, because this is the account where we put everything sold to customers on credit. We keep a record of the balance owed to us through accounts receivable. Okay, something else is happening in this transaction that involves inventory, because if we are selling textbooks, which are inventory items, that has to mean that once we sold them, we no longer have all of the 100 textbooks we bought. So that means we have 30 less textbooks. So what happens there is we should also be affecting merchandise inventory account, and we should be affecting cost of goods sold, because that's normally what's associated with a sale. When you sell something, it has to be worth something, and we have to record how much that item is worth that was sold. And so just looking at these four accounts, this is a revenue account. Accounts receivable is a asset account. Merchandise inventory is an asset account, and cost of goods sold is an expense account because it's a cost. So let's look at each of these transactions to figure out how they can be affected here. Textbook revenue, we have our first sale for the month, and so that means we have to increase the value of sales we say we have, the value of revenue we have. So that's going to be increased. It's a revenue account, so we're actually going to increase it with a credit. So this is one of those accounts that needs to be at the bottom and it needs to be indented. Accounts receivable, we're saying that the Anglican school now owes us for these books that they got on credit, and so therefore we have to increase the balance in their account. That's an asset account, so to increase is debit. Fine, so we can leave that there. Merchandise inventory, what's happening with that account? Well, we no longer have those 30 books we sold, so that has to have decreased. It's an asset account, and so therefore in order to decrease an asset account, we have to credit it. Cost of goods sold is an expense account, and what happens with this expense account is we are increasing it because we're saying that's additional cost that we can now put on our income statement because it's now sold. And so what happens is that's going to be debited because it's an expense. So these would be the accounts, the four accounts that go along with whenever we're selling inventory underneath the perpetual system. Accounts receivable or cash. If the person paid cash, then it would be cash. Cost of goods sold, textbook revenue, and merchandise inventory. And so now the value is how much are we recording everything for? Well, the Anglican school came in the store and they purchased 30 books for $50. That $30, 30 books for $50 is how much the Anglican school has to pay us back. And so definitely accounts receivable is going to be affected by the value of all of the books that they purchase. So they purchased 30 books and each of the books were $50. So 30 times 50, they owe us $1,500 for those 30 books. If This is what happens in accounts receivable. Worth mentioning is accounts receivable and the revenue always go together. And so therefore the credit is going to be for 1,500 to textbook revenue, because that's the value of the sale that we made. That's the value of the revenue. And so we're increasing our revenue because we're saying we sold $1,500 worth of material, of books. Now we have the cost of goods sold balance here, and the cost of goods sold and the merchandise inventory account reflect the value that we paid for what we sold. We sold 30 books to this company and we actually sold it for $50. However, these 30 books cost us $25. And so that means cost of goods sold needs to reflect the cost of the 30 books we sold, the overall cost. So that'll be 30 books times $25. We paid $750 for these books. That is going to be what the cost of goods sold is, as well as merchandise inventory is going to decrease by this amount because we're saying that we no longer have $750 worth of textbooks at our disposal. And so we have to reduce the inventory account by that amount. And so we can just put that here. We sold inventory on credit. And that's actually it for that transaction. I'm just going to make this bold here. Bold. Okay, so let's move on. Moving on the 8th for 8/20, a customer walked in and purchased one textbook for $50. This is going to be similar to what happened on the 7th, except that they didn't say that anything was done on credit. So what I would say is all of these same accounts still apply. With every sale, these accounts apply, except for one. Because this is a cash sale, because they didn't say on credit, we have to now take out accounts receivable and put cash, because we're going to increase cash for this $50 for this one textbook. And so in the same way we handled the question above, cash is going to be affected by $50 because we sold it for $50, so we would receive $50 and our sale is valued at $50. The cost of goods sold remains the same because we're still selling this one item, and the cost is 1 times the $25, which what we paid for it. That's the cost of the business. And so $25 and $25 affect cost of goods sold and merchandise inventory. And what we can put here, because that's done, we sold inventory for cash, or we can put cash sale for inventory, and that's the third transaction. Okay, the transaction on the 12th says that the Anglican school returned and brought back 10 books that were damaged. You agree to give them credit. Now, what's happening here is that of the 30 books they bought, they don't want 10 of them anymore, so they returned it to us. When they return something to us, technically it's not a sale anymore. So what happens is we have to reverse the sale from the books, as well as if they gave us 10 books back, we have to either put them on our inventory or throw them away. In most instances, companies would put them back on the inventory and return them to the vendor for some type of credit. And so what's worth mentioning for these type of transactions here in returns, what we actually should be recording is going to be similar to what we recorded above for them. What we're going to do, the only difference is we're actually going to change some of the accounts, but most of them remain the same, but just they're going to be treated differently. So textbook revenue and merchandise inventory would actually be the accounts that are debited in this situation, because we're taking out the revenue that was recorded. We're taking that out, And we're also taking out the value, putting back the value of the inventory that we received. And so the value of the inventory we received would be the $25 times 10. It would be the 10 books we got back. So that would be $250 we received back. And like I said, always going in merchandise inventory is cost of goods sold. Cost of goods sold would then be credited for $250 to take it back out of cost of goods sold, because technically it's not sold. If it's not sold, it doesn't belong in that account, and so that's going to be credited the opposite to take it back out. The other account that's going to be affected, just as cost of goods sold was, is going to be accounts receivable. Accounts receivable is now going to be reversed as well. It's going to be credited because now they return 10 of the books, and so we actually don't expect to get $500 from them because of that. 500 being the 50 books, $50 times 10 books. And so we expect to get that back. Now, the only difference with this is that textbook revenue account, normally we don't credit or debit that account directly. Normally there is a particular account that we do affect, and that account is called sales return and allowances. So sales returns and allowances would be the name that we change it to, and the value of it would just be the same $500, which is the value of the return. Why this is done is because it just keeps track. Normally when we put something in revenue, we don't go back in revenue and take it out, but we would go back into cost of goods sold and take something out. It's just that revenue is treated differently. And so this is pretty much all that happened. Returned, sales return made by the customer could be the description given. And that's what's happening on the 12th. Let's move on to the 20th. On the 20th, it said the Anglican school sent a check in the amount of $1,000 on their account. What's happening? They're making a payment. When a customer is making a payment, all this means is that we have to further reduce the accounts receivable account for the payment made, because it's no longer due. It's no longer receivable. And so the two accounts affected would be accounts receivable and cash, because if they made a payment, then we're going to get more cash. More cash, being a asset account, is a debit, and reducing our receivable, being an asset account, is a credit. So let's just change the order then. Indent, and they paid $1,000, so we have an additional $1,000 of cash, and we have to decrease our accounts receivable account by $1,000. Now what's happening here is received payment on account. Okay, perfect. And finally, on the 21st for 21/20, it says that the company returned the 10 damaged books and received a refund. So that means the 10 books we added to merchandise inventory no longer belong there, because we took them out and we sent them back to Walmart. And so that definitely means merchandise inventory is an account affected. And then they said they returned the books and received a refund. If you got a refund, that definitely means cash is involved. And so let's think about it. Merchandise inventory, we're sending merchandise off, so it's no longer in our possession. So therefore we have to decrease that account, which is an asset, by a credit. So let's put that down there, and let's indent. So that therefore has to mean that cash is most likely going to be debited. Think about it. We got a refund, so that means that cash is going to be given back to us as compensation. And so therefore, yeah, the cash is going to be increase with a debit. The value of it is going to be $10 times the amount that we paid for it, because normally you get a refund based on what you paid. And so cash is going to be 10 items at $25. I expect Walmart to give me back $250. And the value of my inventory is $250 less. And so this is returned inventory to the vendor. And this is what's happening here. And this is a good description for what's happening here. If credit was given, then we would have done this to accounts payable. But worth mentioning is that we should know that we don't affect accounts payable, because when we purchase these items, we didn't purchase them on account. We purchased them with cash. And so that helps us to know when we return an item, normally what should happen. It should be the same thing. It's normally the reverse. So if you look at it, cash is debited, merchandise inventory is credited, and when we first bought it, the opposite happened. And so that's important to know. As always, if we total up our debit side and our credit side, they should balance. And I'm going to use my famous double underline. And let's take that over. And they do balance. And so that gives me comfort in knowing that that's correct. But this is just a perfect example of the perpetual inventory system and how to work with it.